You're listening to Kerry Lutz's Financial Survival Network, where you get valuable information you just can't find anywhere else. To thrive in today's trying times, you need the Financial Survival Network, now more than ever. Go to financialsurvivalnetwork.com and get your free newsletter and gift. Financial Survival Network, now more than ever.
Welcome. You are listening to and watching the Financial Survival Network. I'm Kerry Lutz, and today is 3/3/2021. Well, interest rates, have they stabilized? Are they going yet higher? And what does that mean to your portfolio, your investments, your family's future? I'd like to know what you think. And if you send me an email, I will sign you up for free for our newsletter and a couple of other things, a couple of white papers on Bitcoin that we're in the process of updating, how to store your metals for free and have 24/7 access, a couple other little goodies there. The email address is kl@kerrylutz.com. Well, our good friend Octavio Marenzi is with us now, and Octavio's site, which you should definitely take a look at, is Optimus.com. That's OPIMAS.com. Octavio, welcome back. So interest rates, that's what's on everybody's mind. I always look at it as like it's a pickpocket. And the way a pickpocket gets the money out of your pocket is they distract you with something else. Wall Street is just a gigantic Fagin machine. If you remember Fagin from the Charles Dickens classic Oliver, he's training these little kids to be basically klepto-maniacs and steal everything in sight. And that's kind of what Wall Street's all about these days, isn't it?
I don't know. I mean, I don't know if we go that far to say it's all about theft and stealing, but it certainly is a strange environment at the moment. I think what we're seeing there is interest rates certainly above the 3-year term have been inching up for some time and finally started to worry people in the market and hit companies that have sort of longer term growth prospects fairly hard. And of course, if your prospects for earnings are way out into the future, then a higher interest rate is going to have a really disproportionate impact on your valuation. And that's what we saw happen. So a lot of the tech stocks got hit fairly badly. Now, the question, I suppose, is have we now found a stable plateau? Are the 10-year yields going to remain below 1.5%? And is everything back to normal? Can we now breathe easily? I don't think so. I think what we've seen is basically everything above sort of the 3-year yield start to inch up. Up to 3 years, everything is very, very low still. And that means we've seen a radical steepening of the yield curve over the course of the past few months. And I don't think that's going to change anytime soon. I think the inflationary pressures are going to carry on growing and increasing, and that's going to drive up longer-term interest rates. And so I think this is a story that we're going to be stuck with for some time to come. The market has a tendency to reassert itself in unusual ways. And I think the Fed and other central banks have been sort of suppressing interest rates as best as possible. But to your point about it being basically a bunch of kleptomaniacs, I suppose, I mean, that's one way of seeing it. I think there are a bunch of people out there acting in good faith and trying to help people make good investments, and it's not always easy. The market's done phenomenally well over the course of the past year, so I think a lot of people are very happy with where things have gone.
Yeah, well, you can't argue with success until it turns into failure, and you know that paper profits, nothing is more ephemeral than paper stock market profits, because very rapidly they can turn into paper losses, and for some reason paper losses are much more painful than paper gains pleasurable.
There is a very bizarre asymmetry there, isn't it? That we tend to react far more negative things than we do on the upside. And that's an interesting aspect of human nature, I suppose. But it's not just true of investments, but of so many things, I think, in life, that you tend to respond to negative things more forcefully than positive things.
Yeah, because the chemical dopamine, which is produced along with others by your pleasure center, is relatively short-lived. That's why you keep needing to get more hits of it through various activities in life, whether it's eating a pepperoni pizza or making $1 million on the latest stock or cashing in on Bitcoin, whatever it is, you want more and more and more of it. And because it's short-lived, you need more and more. Whereas the pain chemicals, I think the ones that are sending out cautionary signals to your organism saying you're under attack, you got to get defensive, whatever, those last far longer than the pleasure chemicals, which are very short-lived.
I suppose it's also on the downside, if you think about how that probably came about into being, is that on the downside, the cost can be enormous. I mean, you might get yourself killed. On the upside, there's not infinite upside, but there is sort of infinite downside as a human being. So that's probably why we see that kind of asymmetry there. But in terms of what that means for the markets, yeah, I mean, there are a bunch of people, of course, making millions on Bitcoin and things like that. It's also been interesting to see the things that haven't been moving up. Things like gold have been sort of stuck in a rut for a while, which is interesting to see. It seems that a whole bunch of people who previously looked at gold as sort of an inflation hedge have now turned to Bitcoin, and that's their new favorite inflation hedge, which means that the investors left in gold now are not those people so much anymore, but more sort of momentum players, I think, more than anything else. That means that price sort of drifts up and down and is a bit unpredictable and volatile now.
Hey, it's kind of like John Maynard Keynes said, gold was a barbarous relic, and now maybe Bitcoin has really turned gold and silver in terms of wealth protection truly into barbarous relics.
It's possible, I suppose. I'm not a huge fan of Keynes, and so I don't think he always got everything 100% right. Maybe he's right on this. I don't know. But these things do seem to have a way of coming back. I do think on the Bitcoin side that there is a very substantial risk that at some stage, some central bank or regulators or governments decide that they don't want to keep it. And I think you and I talked about that last time we spoke, is that there is a sort of a huge regulatory risk there, a legal risk, that at some stage, some regulator says we're not allowed to use this anymore. And I know technically Bitcoin is designed to get around that, but I think a lot of people will adhere to that law, and the authorities might make life very uncomfortable for people who don't.
Yeah, well, I always make the joke, what if you could be arrested and prosecuted and sent to prison for 5 years for possession with intent to distribute Bitcoin? How many of you out there would still be doing it? And I know it's kind of silly and maybe it won't happen, but maybe it'll just be like gold confiscation. Or what if they just go to the largest banks, Bitcoin banks, talking Coinbase, Genesis, others, and they just close them down and take the Bitcoins for themselves. They take all the marbles, they take all your marbles, and they send you home crying. They can do this under national security guidelines. They have every right in the United States to do it. Now, I'm not belittling the value of Bitcoin. I do see value there, but Bitcoin, by its very nature and the lack of sophistication of the parties who are involved in it, other than the really big players, makes it susceptible to these parabolic moves and then parabolic crashes. I just see it as really, maybe it will be a better hedge than gold. I don't know. But until I can go into Tesla, slap down 1 Bitcoin for a Model Y, or I can go to Starbucks and buy my $5 latte for a 10,000th of a Bitcoin. It's not a currency. It is not a medium of exchange. It is an asset. And just because you call something a duck, if you call a seagull a duck, right, the seagull is still a seagull. It's not a duck. You can call these cryptos whatever you like. I like crypto assets. Cryptocurrencies, no. I mean, they keep saying, and now PayPal, you can buy crypto with and all of that. That's great. And it might bring it closer to the day where it's a currency. But until the day arrives where I can go into Starbucks and buy my latte as seamlessly as I do with these rapidly depreciating fiat dollars, it's not a currency.
Don't just survive, thrive. The Financial Survival Network.
Doré Copper Mining is a premier, near-term, high-grade copper and gold redevelopment opportunity with tremendous exploration potential only 14 kilometers from the town of Chibougamau in mine-friendly Quebec. Doré Copper is debt-free and owns a 2,700-ton-per-day mill with an 8 million-ton tailings facility ready to be used. There is already power to site, and it is accessible by paved highway and rail. Doré Copper aims to produce a profitable hub-and-spoke operation of over 100,000 gold equivalent ounces per year, or over 60 million million pounds of copper equivalent by 2024. Because of the existing infrastructure and location, a low capex is anticipated to recommence production. Doré Copper trades under DCMC in Toronto and under DRCMF on the OTC. To learn more, go to dorecopper.com. That's dorecopper.com.
This is the Financial Survival Network, the information you need to thrive now more than ever.
Indeed, it's not money. It's not money. It has to be widely accepted. It has to be a very marketable asset. It has to be money to be the most marketable asset, and otherwise, it's not money. But Kerry, you raise an interesting point about the gold confiscation. I assume you're talking about FDR back in 1933 or something around there. How aggressive did they have to get people to stop using gold as a monetary asset? Because back then, people did pay for things with gold coins or with silver coins, as well as with paper dollars. It was sort of a parallel currency. So how hard did they have to hit people to stop them from doing that?
There weren't really many prosecutions at all. There were loopholes to the law. If you went to open your safe deposit box, a Treasury agent had to be present. They did take a number of measures, but the American public back in 1933, 1934 was much more compliant. There was no internet, there was no alternative media, and you basically bought the government's BS hook, line, and sinker, or you were really unpatriotic and you were ostracized. So the fact is that really those were really different times, and people did what they were told. People still do. I mean, half the population, we don't need to get into it. You and I both know what I'm talking about, but there are far many of you out there who question everything the government tells you, whether it's vaccines, whether it's the COVID epidemic, whatever it might be. You are questioning every move they make. Sometimes you're wrong and oftentimes you're right. But nonetheless, critical thinking is really, it's at more of a premium now, Octavio, I think. But there still is too little of it. And even critical thinkers can get conned.
Indeed. It's not. But there are encouraging signs here and there, I think, of in terms of people thinking independently. So that's maybe moving in the right direction.
Yeah, we can only hope, for sure. And I think as government policies lose their effectiveness, you become much more likely to question their competence, their policies, their players, their priorities, what they're really after, and how those policies really affect you, your family, your wallet, your ability. The pandemic is a perfect example in the reactions of certain governors to close down economies indefinitely until some impossible, unobtainable goal is achieved. It's coming home now to people that, these guys really, maybe everything they say isn't true. And we can only hope that this is a massive wake-up call, not just in the United States, but to humanity as a whole, because these idiotic policies have been followed all over the globe, right?
Yeah, and I think there is some resistance starting to build. I see that certainly in Europe, where there's increased open questioning of things, and we're starting to see more demonstrations and riots. They don't get reported on very much, so they sort of keep a bit quiet. But we've seen that happen now in Germany, in France, and in the UK. People getting out and demonstrating against some of the government policies, particularly around COVID-19. But a lot of that has been fairly suppressed. But I get the sense that there's more and more of a groundswell against it, for better or for worse. But the people are getting uneasy about this.
Okay. Most important asset you can have in the current economic climate is the ability to think critically, think out of the box, and not follow the crowd off the cliff. But we'll kind of leave it at that. So if a new investor came to you today, Octavio, and said, I got $500,000, what should I do? I just cleaned up. I managed to buy GameStop, and I actually was able to sell it. I bought it at 13, sold it at 500, made $500,000. What would you tell them to do?
I would tell them that they know more about markets than I do. And that they should invest the money wherever they think it should go. What would I say at this stage? I would say keep a very heavy equities focus, keep as much money in equities as possible for the time being, but be ready to jump out of it very, very quickly. So once you start to see interest rates hike, be ready to run for the doors. And it's a difficult thing to time. So I think that's going to be the story, is that once the central banks feel obligated to start to raise interest rates, that the markets will crash, and that will happen quite quickly. And everyone, I think, or most smart investors are watching for that to happen. So everyone's going to be running for the door at the same time. So the question is, what am I willing to sacrifice? Do I try and get out very quickly and lose on the upside? Or do I try and stick it out thinking that this time things are going to be okay? I think that's the basic thing. So I think one should remain fairly heavily invested in equities at the time being. Bonds are not terribly interesting investment vehicles at the moment. And within equities, there's certain sectors that I think are kind of interesting and kind of undervalued. The banking sector is one that comes to mind. The banking sector is one of the sectors that could really benefit from a steepening yield curve. So if longer term yields go up, the banking industry actually stands to gain quite substantially. And the banks are actually looking very, very cheap at the moment. So if you look at the PE ratios of things like Goldman Sachs or Morgan Stanley or people like that, they're actually shockingly low compared to some of the tech stocks. They're like, some of them are 10, 12, 13, something like that on the PE ratio side, which is kind of incredible.
Hey, so return to value. Well, it's funny, when bull markets end, the value investors kind of come out of the woodwork because you can actually find value. Here, it's very difficult to find. Anyways, the leaf blowers and the hedge cutters are about to attack my front yard here. So we've really got to get going. But Octavio, just tell us best way to connect and what you can do for us out there.
Well, best way to connect is my email. It's om@opimas.com. And what do we do? That we're not really investment advisors at all, but we do advise large institutionals about what's going on in capital markets and how to position themselves and what to do in terms of business strategy. So that's basically the area that we're in terms of doing. So we advise the institutional investors and banks and broker dealers and people of that sort on how to sort of play things on an operational side, technology side, and strategy. So those are the areas that we focus on.
All right. If you got a question for Octavio, feel free to send us an email to kl@kerrylutz.com. Don't forget, take a look at our Twitter feed @KerryLutz, and of course, our website, financialsurvivalnetwork.com. Just go there, sign up for a free newsletter. Got some more coming out real soon to you with some great articles. We're going to do It's the Dopamine Stupid Part 2 article, an article that I wrote in December of 2017 when Bitcoin was peaking. I published it in early January after it started declining, but I think you should take a look at it again. Octavio, always a pleasure. Thanks so much for stopping by.
Thanks, Kerry. Take care.
Thanks for listening to Kerry Lutz's Financial Survival Network, your solution to today's trying times. For the latest, go to financialsurvivalnetwork.com. Financial Survival Network, now more than ever.